All right. Welcome everybody who's just joining us, the early attendees. Welcome to tonight's JUMPinar. Just give us a few minutes here to let others join in, and we'll get started very shortly. All right, we'll give it about 30 more seconds here and then get started. Thanks everybody for showing up on time tonight. Okay, welcome everybody to tonight's Jumpstart Germantown JUMPinar. This is a weekly webinar series that we've been hosting for about the past 2 years now, every Monday night at 7 p.m., or now every other Monday night at 7 p.m. But we cover special topics in real estate that we don't have time for, or can't necessarily delve deep into in our standard training program. So these serve as sort of a little extracurricular, public education that I'm happy you guys are all here to join us with. Tonight's topic, we're talking about real estate depreciation, and this is a schedule that has been postponed, I think, twice now. One due to technical issues, and the other just scheduling. But no worries, we're finally here and excited to talk with our guest John McGovern tonight. But before I let him introduce myself and we get to the introduction of the topic, I just want to give some general updates about Jumpstart Germantown, and I'll let Maeva start here, and then we'll move on to the rest. Maiva, you want to tell us a little bit about what's going on with Jumpstart?
Oh, yes. So, as you may or may not know, we are still offering short-term loans to beginner and experienced developers. Therefore, the acquisition and construction of residential projects in different Philadelphia neighborhoods. I added the links to our website so we have a map with the different neighborhoods we land in. So if you think you have a project that might be in there, feel free to go on the website, find out information about how to apply. And if you have any questions, there's an email also in the chat to reach out to. Thank you.
Great, thank you so much, Maeva. And another Jumpstart update is about the PHA lottery, which Maeva, if you could also pop that in the chat. We have announced the round 3 of our PHA lottery that we're able to lottery off properties to Jumpstart graduates who will acquire the property for a nominal value and then rehab it with a Jumpstart loan and make a profit to use for their next project. So the property sourcing lottery is open. I actually don't know the exact dates, but just head to the website in that Maeva is going to drop in the chat there, and you'll be able to find out all the details. And if you are a graduate of the training program, you'll be eligible to enter the lottery. So definitely check in on that and email us with any questions. And a lot of housekeeping this week. Sorry. One more thing is that this is actually Maeva's last week here at Jumpstart. She was our co-op for the past 6 months with Drexel, and just big round of applause. I know we're all virtual, but big round of applause to Maeva for an excellent 6 months at Jumpstart. And she's been a huge help and kind of nice, consistent backup here on Monday nights. And Maeva, I'm sure you've learned a lot at all these JUMPinars and been very
I
helpful
did.
in the process. Cool. All right. Well, Maeva, thank you so much. And I get to spend the next week with Maeva, but you guys will, just have had that experience with her at Jumpstart or JUMPinars on Monday night. So thank you, Maeva. Um, all right. Well, let's get into the topic here. I'll just let my guest here, Jack, introduce himself. He is a tax attorney who can help us out with some questions about real estate depreciation and also since tax season is upon us, we're going to talk a little bit about some general questions you guys might have about your liability as developers, or things more general than just depreciation. But I'll let him introduce himself, and then we'll jump into his agenda here. How's it going, Jack?
Great. My name's Jack McGovern. I'm actually a CPA, a certified public
Oh, I'm
accountant.
sorry. I didn't. I knew I messed up that word. I
I
meant.
accepted credit for being an attorney.
Yeah.
I don't worry I'd get sued.
Yeah.
And accountants can't practice law without a
Right.
license.
Right. I got those A words mixed up, so I apologize.
Although we do look at tax law quite a bit. Uh, and we're based in the Manayunk section of Philadelphia. We do a lot of work throughout the city. So I'm looking forward to talking to your audience.
All right, awesome. So I think you're good to share your screen and we can jump into your agenda. Unless there's any more background information you want to give, we can jump into maybe I think this might be a little bit of a review from the first session.
Yeah,
Right?
am I screen sharing? I'm never sure if
Yep,
my
I see you.
screen's up. So this is who I am. And I always look about the different types of real estate we work on: duplexes, triplexes, quads, commercial buildings, mixed uses, ultimately to credit buildings like CVS's, 7-Elevens, and flips. So when we get into like discussing real estate, these are all the different types of commercial real estate. And really, people ask me, why do you do real estate and depreciation and things like that? But the number one thing is to build wealth. And the other thing people like to do is create passive income so that, when they get to retirement age or early retirement age, or even during their income, to supplement their income. And a good way to do it is to reduce taxes through depreciation. We'll talk about that tonight. The other good thing about real estate is that you can use leverage. And what leverage means, if you put 10% down on a property, for every 10,000 you put down, you're controlling $100,000 or maybe $50,000 of real estate. So that's what we call leverage. And arbitrage is the same. You get to utilize that, and you can generate better rates of return than what you get at the bank. Like the bank only pays you 1 or 2% interest now, and credit properties pay you much more than that. But the thing that Derek reached out to me tonight was to focus on depreciation. And depreciation is a great topic. We talk about, what is depreciation? I'm scrolling around, and if you have questions you want to ask me, Derek, but I like to start out by just defining what depreciation is. And what happens is when you buy a property, whether you pay $50,000 or $100,000, you're not allowed to deduct that property in one point in time. Depreciation is really the annual deduction you get. So when you have an asset that's considered a capital asset, that's an asset that lasts longer than 1 year. You have to capitalize the asset and then depreciate it over its useful life. And so people want to know, why do you have to do that? Well, the reason you have to do it is because that's the tax code, and that's where the attorneys come in. You have to follow the law. And depreciation gives you the deduction over a period of time. And where you gain, you first have to understand what depreciation is, and it's made up of different classes between like buildings, machinery, vehicles, furniture, and equipment. And these all get depreciated as you would expect over different lives. Certain things like patents, lease rights, and computer software get amortized. I view amortization and depreciation kind of one and the same.
Yeah.
The other thing with depreciation, like a landmark thing, is you're not allowed to depreciate land. So when you buy a property, you have to put land value to the property. So when you think about that, it's important that you develop strategies how to come up with the land, because that's always a bit of a subjective list, guess or whatever. In Philadelphia, Philadelphia does a good job when they assess a real estate building. They'll put the land value up there and they'll also put the building value, and you can use that. Rarely do they match totally to what the sales price is. So then you can use like a percentage or other type of method.
Mhm.
The other thing that you have to really think about in real estate is that developers are not allowed to deduct inventory. So if your property is considered inventory, in other words, like you're building, 20 townhouses at one time, that might be considered inventory and you can't depreciate those items. So there are different nuances that you have to kind of be aware of. The other thing with depreciation is you have to own the property. So it sounds fundamental, but sometimes people pay for something for a family member or something else. Well, you can't deduct it unless you own it. And it must be used in a business or income producing. So you can't depreciate like a vacation home. You can't depreciate your first home. So that's something that's there. Number 3 is it says you have to have a determinable useful life. And that's why land is not deductible. Theoretically, land lasts forever. So you can't depreciate land. And then the asset has to last for more than 1 year. So some things you get to differentiate between repairs and land. When you think of or an asset, when you think about assets, you think about when the first time you buy them. But each year, sometimes you do a major renovation, and because it lasts more than a year, you have to capitalize that and depreciate that.
Yeah.
So you have to really think about that.
So Jack, it sounds like for a jump starter, like the sort of property that they would be most likely to depreciate would be like a rental that they own, or that a rental that they had previously rehabbed, refinanced with the bank and own and are renting to tenants.
Yeah,
If they have and hold that property for longer than 1 year, then they would be eligible to calculate this depreciation in, right?
that's correct.
Okay.
And the other thing is that it can be financed. So what's important to know there is that, let's say you put, like in a typical jumpstart type property, I'll use a number like you paid $50,000 for the property, and you're going to do another $50,000 of repairs to that property, and you're going to borrow, and you're going to do it with like a 20% down payment or $20,000.
Mm-hmm.
Well, the fact is, back to my leverage comment, you're able to depreciate the whole $100,000. So that's pretty good. And then even better is that you get to depreciate more rapidly the improvements you make. So if that's your typical jumpstart deal, that's where it really helps you.
Right. And the important, I guess, distinction is it would have to be a buy and hold project that you're not just like selling once construction is complete, right? Because that
Correct.
right.
Correct, because that's what I call a flip. Like a buy and I call buy and hold versus flip. A flip you really don't depreciate. And the other thing that you'll see, and when you come down here, the property has to be placed in service. So that's an important fact. So I get that right now during tax time. The property has to be complete and available for rental, so that if you're rehabbing a property, and these things never, they oftentimes cross fiscal years or calendar years. And so it has to be finished in order for you to begin depreciating it.
Mm-hmm.
So that's an important point.
Okay.
And the other thing is to follow on with that is that to merely pay for the property or the improvement doesn't mean that it's a deduction. So a lot of times you'll have people at the end of the year scrambling, hey, I'd like to put this hot water heater in, and I'll pay the contractor, but unless it's installed, it's really not allowed to be deducted. So, and then the other thing too is sometimes you get into January and the work was done in December, and the contractor, sends out the bill to you and he puts on there, the current date. You should go back to him and say, please, correct your invoice because we had this work done, at the end of the year. Mm-hmm. And so that allows you to deduct it.
So it sounds like when you're dealing with things that are like or you should always, I guess, be conscious about the timing at which stuff is taking place, because you want to make sure you, like, when you're reporting that it's depreciable, you know when it started, right? That there's like evidence of it.
Yes, and when you think about it, I don't know how to say it, but it's hard to fudge. Like sometimes you get like COs, certificates of occupancy.
Right.
So when is the property placed in service? That becomes a question. You know, when you're dealing with something that involves a permit, it's generally, you know, the date the permit's issued, you know, or that it was available to be, you know, rented.
Okay. Gotcha. That makes sense.
Um, and so that gets back to merely paying for it doesn't make it deductible. Then the other things to think about, the depreciation goals are to maximize your tax deductions, you know, and then usually in the first year or second year that you own a property is when you get the maximum depreciation. What happened is there's been many stimulus bills that have been uh, brought out in the real estate industry since my whole career's been in. So they have a section called 179. That means you're allowed to deduct something in 1 year. So that's, you know, something that people get a benefit of the first year. The other thing is there's something in the tax code called bonus depreciation, which means you're allowed to depreciate. It used to be 50% of an asset. Now it's 100%. So many people that are doing like rehabs and things like that are able to deduct 100% of their asset rehab in 1 year. And that's important to know because in the first year, you get a big tax deduction on that.
Mm-hmm.
And then the other thing with depreciation after that is that really you want to stabilize your cash flow, and you would hope that you would break even cash flow wise. And oftentimes the first year, claiming a large depreciation deduction gives you a tax return.
Mm-hmm.
How do you get a tax deduction? It really depends on your income stream. So if you have income from another job source, let's say you're married and your spouse has a W-2 wage, or this is a second job for you, that's how you can get back money that is paid.
Right.
If you're not paying taxes, you're not able to get a deduction. I'm sorry, Derek, did you?
No, you're good. I was just gonna ask a clarification. So, like, it's not, depreciation isn't just beneficial, you know, for when you hold the property for like a decade or 15 years. Like, it could be just as profitable, or you know, just as money saving for you to do it within just even the first year of owning. Right? It's not
Well,
like.
more than that, it's generally what happens is depreciation is, you know, you take depreciation over the useful life of a property.
Mhm.
The special allocation, the special depreciation rules allow you to front load the depreciation, which allows, you know, a new developer to take depreciation and turn it into real cash. And how do you turn it into real cash is you accelerate your depreciation, and then you use that to create a loss on your property, which you then can use to offset against other taxable income that maybe you've already paid tax on. And that's where you get the refund. That's how you monetize it. So claiming depreciation does not monetize it. You have to have other, you know, sources of cash flow that are being taxed that helps you.
Right.
I don't know if it's clear, Derek, if you follow that.
Yeah, yeah, it does. And I think it's just important to note that, like, it's not something you need to wait for. Like, you want to go, you know, once you acquire ownership of a property and start using it, it's you want to be considering depreciation from the onset.
You want to do it immediately, and you want to take as much as you can. And
Okay.
then how do you claim depreciation? There's a form 4562 that's utilized to create the depreciation and amortization deduction. Generally, there's software or an accountant or somebody would help you do that. I know many of the people in your audience may do their own taxes, so they would use TurboTax, and there's different classes of depreciation in there that you can take.
Mhm.
And the then you get into my next question. This
Yeah.
is where it gets a little dry, but you
So
have
before we move on to that, Jack, I didn't say this at the beginning, but we are going to have a Q&A at the end of the discussion here. So there's a hand raised I see from Wanda, but Wanda, if you could just type in your question into the Q&A on your toolbar there, we'll get to them right when we get through Jack's notes here. But yeah, Jack, go right on ahead and doing great so far.
Yeah, and just because it's tax season, I would like to give you guys a chance if you want to ask any question about taxes, that if I'm able to answer, I'm happy to do it. But with depreciation, you get into recovery lives, and recovery lives mean you're either 3-year property, 5-year property, 7-year property, 10-year property, 15-year property, 20-year property, 25-year property, or residential property, which is 27 and a half years, and non-residential property, which is 39 years. Typically, when you buy and by the way, the higher the number, that means the longer it takes you to depreciate it and the less depreciation you're getting in 1 year. So you would rather be up in 3-year rather than 39-year. But you have to go by what the rules say. Non-residential real estate is typically like, people don't have tenants in the building that are residential. So it would be like a CVS, a 7-Eleven, a corner store, even like I personally, the accounting firm that we own the building. So that would be non-residential property. Then residential property is 27 and a half years, and that gets depreciated over 27 and a half years. And that would be like, a single family home, a duplex, a triplex, a quad, something like that. And it's always pretty much the initial property there.
Mm-hmm.
The next jump, 20 and 25-year property, is pretty rare. You don't really have that. The 15-year property is really leasehold improvements. And in the real estate world, we really have generally 5 years can be furnishings, 15 years can be like a major fit out where you're doing like not building an addition. Like if you build an addition, that would fall into 27-year property. If you're gutting the interior, that would be like 15-year property. If
Okay, I see what you're saying. So it's basically like they're classifying your depreciation amount based on like the scale or the length of the property you're going to extend with your renovation, right?
Yes. And when you think about it, I'm a guy who practices what I preach. I have some rental properties myself. And typically the best way to run a rental property is to keep tenants in there and then freshen them up and keep them nice. And then every maybe 10 years, 5 years, 10 years, you have to, when somebody moves out or whatever, you have to go in and you find out that the vinyl kitchen countertops, are really, you can't rent unless you go with like a granite table top or something like that, to be able to compete with the other places. And what I've noticed is in Philadelphia, the furnishings inside have gotten a lot nicer over the years. And so anyway, so you fall into like, generally the remodel falls into like the 5-year, furnishings. And the remodel would be the simple things like carpeting, maybe you're, just doing like a clean out or something like that. If you're doing a just repairs, you notice I'm talking about depreciation tonight, but I probably should have led by saying there's a difference between repairs and depreciation. Repairs mean it's only 1 year. So you would rather everything be a repair if you could. So like when you get in and you're flipping a property or you're flipping tenants, you would want to clean out the place. It could be a repair or it could fall into the 15-year property, the 5-year property. The 27-year property would be more like you're putting an addition on, or you had, you buy a property that has 2 units and you want to make it into 3 units by putting an addition on. When you have a property that's kind of in bad shape and it's, let's say, a shell, and you want to put 2 units into 3 units, but keep it all within the same shell, that may fall into 15-year property. So there's a little bit of decision that goes into that when you choose what you have. But again, you want to rapidly depreciate this in order to have it. Another term you'll have is something called listed property. Listed property is really like cars, computers, and things like that. And what does listed mean? it really is like you can't deduct 100% of it. So, we're really talking about real estate tonight, but people who buy a car and say, hey, I want to depreciate my car, that's called listed property. And a good way to get audited is to put down 100%, because for listed property, people don't really believe that, unless you own like a trucking company or your business has just that you can take 100% of, your car, something like that. However, you can take, as a real estate developer, if you're, maybe you work during the day and you drive your car to do your rehab or something like that, you definitely could depreciate your car. And so listed property is really defined as anything that has 100%, not 100% business use. Another thing that I wanted to talk about, from a big picture, is the depreciation recapture. So one thing that happens that can sneak up on people is that, using my example in the past, you pay $25,000 for a property and you put maybe $30,000 into it and you depreciate it. What happens is when you sell the property, you have to recapture the depreciation claimed. So that's a tough thing for people to understand sometimes, and it's a negative tax impact to you. So like when you sell a property, any depreciation you claim, you have to recapture. And that's something called, that's really just a tax rule. And there's ways to deal with that. There's something called a like-kind exchange that we could talk about in another seminar, or something called an opportunity zone. But again, it gets back to depreciation, that's kind of causing that. So sometimes people sell a property for $200,000 and they say, Jack, I only paid, I paid $100,000 for it. Why are you putting my gain down at 150? And it's because we depreciated, $50,000 over time. And people don't like that answer, but it's something that you have to realize ahead of time and plan and deal with it before it's time to fill out the taxes. So when people say, what is tax basis of a property? That's what you paid for the property less your depreciated value. So you get to add the cost of any rehabs, but we always have to depreciate, your assets. So once a year, you should really be looking at your assets and say, hey, I've got this asset and I've depreciated it. If I sell it, what would be the impact on my tax return if I sell it? And if you do sell it and it's a gain, what can I do to mitigate that tax? The other thing I talked about a little earlier was accelerated depreciation. And accelerated depreciation is Section 179, which allows you to deduct it in the first year. The problem with Section 179 is you can't have a loss, however, and go negative with it. However, special depreciation allows you to do that. So most people take special depreciation. So it gets kind of weird. I'm really getting technical now. So you may take one or the other, depending on your own tax circumstances. And then I always put repairs here because, there's a law that says that if you make what they call de minimis repairs, which are under $10,000, you can make an election to deduct your repairs rather than capitalize them. And that's what you'd rather do. Then you see this when you start looking at tax rules that get really crazy, and why accountants get hired is there's terms like maker's depreciation. These are like common tax law codes that people look at, but it's really gets back to, I was trying to simplify it, what year property is it? And makers is just the standard term that is a tax code that you can kind of breeze through if you're working on the returns yourself. Another one is, what is a settlement sheet or a HUD-1 and why is it important? Well, that's really a landmark document that you should keep when you buy a property. It documents what you paid for the property. Some people call it a settlement sheet, a HUD sheet, a ALTA sheet, but that's where you really prove what you paid for the property. The one thing that I've noticed in the last year, really 2 years since we've been doing a lot of tax returns via Zoom, people are looking up cost of properties from like Zillow and sites like that, and you can get a history of properties easier. But an IRS guy, if they were auditing your gain or loss, they would want you to keep your settlement sheet that documents what the cost of the sale was. And I wanted to give like an example of the tax allocation of like a $500,000 purchase price. And so sometimes people get what's called a segregated study where they'll have done, so you might say 20% is not depreciating its land. And then the financing fees are over the life of the mortgage. So that's something we would amortize. So let's say you have a 15-year mortgage, we would get to deduct any financing fees over 15 years. If you had a 30-year mortgage, you'd have to deduct it over 30 years. And then you have to put like regular furnishings. So when you look at a building, you would have to have either a study or some kind of informal list of the different furnishings you have. So like if you had a $50,000 purchase, it's conceivable that 10% of it furnishings. And what do you mean by furnishings? Like there could be window treatments, carpeting, things like that that you would allocate to the rental furnishings, and that would get depreciated more rapidly. Land improvements such as like parking lots and things like that can get deducted, you know, as 15-year property. And the remaining $300,000 would get depreciated over, you know, the 27.5 years. The following list here, I'll let you all, it's all in your handout, you know, the types of things that are in here. It's funny, like a racehorse is what's 3-year property. And believe it or not, in Manayunk, people even have horses. So we see that. And 5-year property is typically automobiles, technological equipment like computers, and certain appliances. Real estate can be, you know, classified into 5-year property. One thing that I didn't really talk about, and a whole nother seminar could be on it, is what caught my eye is solar. People who put solar up get what's called tax credits. Tax credits are better than deductions because a credit means a dollar for dollar offset, whereas depreciation lowers your income. So that's a fundamental that in taxes you have to understand. A $10,000 deduction, generally, if you're in the 30% tax bracket, means $3,000. A $10,000 credit means $10,000. So solar, you know, it's something that's really being pushed by the government. They give you tax credits right now that are, I believe, around 25% of what they are. So
Jack, we had a jump in our just a few weeks ago on solar, and somebody from Solar States, a local solar company, came in and talked about it, and definitely mentioned the tax benefits. So if anybody has questions about that, they should definitely go back to that solar JUMPinar we had.
Yeah, and so I've seen it out there. So I don't mean to get hung up on that.
No, you're right. You're good.
And then you get 5-year property here. Then you get into 7-year property. That's like office furniture. You know, I don't think there's any railroad guys here, but there could be. That's railroad tracks. But mainly it's office furniture, desk, files, safes. And then 10-year property, you know, are vessels and trees. So like, it's funny because in Philadelphia, there are small farms and things like that, and you can depreciate trees and vines and things like that. And then 15-year property are basically fences, roads, sidewalks. '20-year properties, the farm buildings. I mentioned there's not a lot of 25, that gets into the municipal buildings. Mm-hmm. And then the residential is probably where mostly everybody's at when they buy the buildings. So you're really dealing, I think, in your audience with the residential buildings and how do you handle like a flip or something like that.
Right. Okay, great. And so is there a way to, like, should you go with a tax accountant to confirm exactly what depreciation or which class your property falls into, or is there places?
I think you should, at the minimum, you would want to be using like tax software such as, TurboTax is very good. And not only that, but you have to track your depreciation schedule on an annual basis. A package like TurboTax, flips over your depreciation from year to year that you get to track it, like how much you claimed in prior years. Accountants are very good at helping you allocate, your purchase prices, if you're not going to do it yourself. A lot of people that I've noticed, we handle a lot of people that own rental properties. And when they get away from doing their own taxes, a lot of times is when they start getting into, the real estate market, especially after they get past like one property, get into multiple properties.
Okay. All right. Well, if it's all right with you, Jack, I think it's a good time to move into the Q&A here.
Sure.
Great. And I encourage everybody. We only have one or two submitted here so far, but please, enter your questions into the Q&A for Jack. Anything, it's all open game here. Tax questions or anything about depreciation. But before we move on to that, Jack, thank you so much for that great walkthrough. I thought that was a great overview of what depreciation was and how it's relevant to developers. So hopefully people enjoyed it.
Do you want me to look in the chat with the question?
No, I'll read the questions out to you.
Oh,
No,
sure.
no problem.
Okay.
Yeah, and so the other thing, somebody asked about the agenda and how they could get it. Maeva dropped it in the chat there, so you can download it. But also, I'll be sending it out in a follow-up email, on Wednesday of this week or so. So yeah, you'll get it at some point. And our first question here, Jack, if it's all right if we move on to that, is going to be from Keith, and he was wondering about if you accelerate depreciation loss at the front end, how is that reconciled when you sell the property at a later date?
Well, that's a great question, and that gets into the planning. So if using my, example, or I'll make up an example, if you have $100,000 property and you claim $20,000 of depreciation in the first year, your tax basis becomes 80,000. So if you sell that property for 120, your gain's going to be 120 minus 80. So in some ways, Keith might be asking, well, gee, why would you do that? Because you're only going to pay it later. Well, what developers do is they figure out ways not to pay tax this year and are constantly getting into new deals and things like that. So they might do what's called a like-kind exchange and buy another property and not have to pay the tax on that. So his question is a great question in that his point is you're not really gaining anything, you're front loading it. But the reason they front load is that, they come up with strategies not to pay on that gain.
Okay. And he actually has a second question. He was wondering if you have a duplex where you live in one unit and renovate the other for a short-term rental, are you able to depreciate the second unit? So that's a good complex question.
Yeah, that's a very good question. And the answer is yes. And Philadelphia is a great place to do accounting business because you see everything. And there's many duplexes in the city, and you're able to live in one unit and allocate your cost, whatever is a reasonable manner, so you might have 50% of it. And many people, get into housing by buying a duplex, living in part of it, and then, turning the duplex into a, 2-unit place when they go, buy a home or move on to something else. So you're allowed to allocate those expenses. It's a great way to get into real estate.
Great. Yeah, I've heard it called house hacking by some other people. Okay, and the next question here comes from Leon, and they were wondering, is it best practice to have different LLCs for each investment property? So I'm not sure how much that has to do with taxes. Jackie might be able to help us out.
Yeah, it's funny because a lot of people ask me that all the time, and I myself have. You can tell by my hairline, I've been working for a while, and before LLCs were out, my wife and I, we had properties in our own name, but typically we'll buy a property in an LLC. Many people have properties in LLCs for a couple of reasons, like you'll see the name of the LLC be the street address. And there's advantages to that. So like the big time developers downtown, you'll see them have an LLC, and you'll see in the paper it sold for $100 million, and then they only pay transfer tax on a percentage of that. And that's because they sell their LLC unit interest, but not their real estate. And so that's a tricky way to do it. But that doesn't really happen to like us common people, I say, because usually you have to clear the title. I find that usually when you have like other partners involved, you should always have an LLC for you and the other partner. Because if you want to have one person come and go, it's easier to, have that worked out. I think that if you have multiple properties, I myself, I have them within one LLC that are owned by just my wife and I. I don't know if that answers the question or not. Tax wise, there's really no difference,
Okay, yeah. So we also had a JUMPinar on I think it was entity formation, or how to set up your LLC or something. We definitely covered strategies on, not from a tax perspective, but obviously because like you said, Jack, it doesn't. But there's certainly a business
Well,
behind
the
that.
other thing is, like in Philadelphia, there can be tax reasons. And, I'm located in Philadelphia and I have properties in Philadelphia. And the biggest thing with an LLC is that, like, you pay business privilege tax or the BERT tax, by entity. So that what I like to do is have one income, over time. I built, from where, it was a duplex all the way up to owning a bunch of properties. And I'm constantly doing something. I have mature properties that make money and ones that don't. Philadelphia, what you can do is if you had an LLC for every property, you might end up paying taxes on that mature property because you've taken all the tax deductions out of it. So that's one main reason I like to have them all in one.
Okay. All right, great. Yeah, and Leon, if you want to check out the recordings of anything we had, any discussions we previously had on it, you can go to the link in the chat there. That's the library of all our JUMPinars. Okay, next question here comes from Lansana, and they were wondering, what's the determining factor for how much I can use towards depreciation for a 4-unit owner-occupied property I bought in August of 2021? She said it's rather vague, but I'm trying to offset the taxes that she owes. So what's your take there?
Well, something like that, what you'd want to do, I don't know the purchase price, but let me just make up $200,000. So you'd have to look at, what can you assess to the land value? And you might look at the Philly website and hopefully it would be maybe $40,000. And then you might do like a walkthrough of the place and find out, what appliances and what items were there when you purchased the property. There could be window treatments, carpeting, things like that. And maybe you have between $5,000 and $10,000 per unit. And then you could take special depreciation on that part of it. And then the remaining portion you'd take over a longer time period. I don't know if that concept you follow, but that's what I'd suggest you think about.
Yeah, great. Just a couple more here. The next one comes from Brenda, and she was wondering, how do you depreciate a inherited property that is a full rehab and will be a rental? So is the depreciation based on the current value or the cost of the rehab?
That's a very good question. And it goes a little bit outside depreciation. It gets into like estate planning and things like that. And sometimes estate planning, you really can estate plan. You just have to deal with the facts. The good thing is in tax law, there's something called a step up in basis. So getting back to, I think it was Keith's question about front loading the depreciation, the way to get out of depreciation is to hold the property forever. Because when you get to your ultimate death and pass the property down to your family, the property gets what's called a step up in value. So let's say somebody owned a property for 25 years and it was depreciated down to the value of 20,000, but it's worth 100,000 at the date of death. You get to step up that value to the market value at date of death. A really important thing to know, like in the tax law planning, is that sometimes people call me, and they tell me their parents are sick and they want to transfer the property, and I say, well, I think you ought to really wait until after, mom or dad passes. That way you get what's called the step up. So these things come up, and it's important that you understand that, but you get to depreciate it at the date of death value.
Okay, great. The next question comes from Leon again, and he was wondering, can you file your personal taxes before a partnership?
You can, but what happens is the IRS requires you to have everything, filed properly, so that if there was a deduction or income that you didn't record, let's say in the worst case, you filed your taxes and the partnership had a profit of $10,000 and you just didn't get the K-1 in time, it's your responsibility to include that income and, if necessary, amend your tax return. Sometimes people, and as an accountant, you have to make decisions sometime or help people make decisions. People like just don't get a K-1 from somebody. So in that case, what we do is we try to understand, what the economic impact was to that person and report that income. But I'd never not file a return because you don't have, the information.
Okay. All right, and our last question here, or sorry, someone just entered another. Our second to last is from Kim, and you already mentioned this a second ago when we were talking about house hacking, but she was wondering, how would a depreciation work if you live in a part of a multi-family duplex? So if you could just review.
Yeah, you would, and I use the term just maybe a little bit of, what would you think as a layman? Well, the part that's personal, you don't get to deduct. So you'd have to allocate, in a systematic manner. If there's 4 units, maybe 25% of it would not be deducted and 75% would be. Sometimes people tell me, I'm in a duplex, but, we occupy 2/3 of it, where we occupy 1/3. So you have to go with the facts and circumstances on each property.
Mm-hmm. Okay. And our actual last question for tonight comes from Dwayne, and he was wondering, so if you leave a property to heirs, so if, I guess your children inherit it, they don't have to recapture their depreciation, is that right?
That's correct.
Okay. All right, great. Cool. Well, that's all the questions we got. Thank you, everybody, for entering.
If anybody wants to email me any questions, my email address is jmcgovern@cpaphilly.com. I don't know if I have it there, but you're welcome to put it in.
Yeah. Yeah, I just typed it in the chat there, and then also, is there a dot in there, or is it just J McGovern?
There's no dot in there. jmcgovern@cpaphilly.com.
All right, great. So I just typed that in the chat, and then also, Jack, I'll send out your CV and the agenda from tonight, so everybody's got that, and then you'll be all good to go. So, yeah, Jack, thank you so much. That was a great discussion, and I hope everybody enjoyed the content.
Thank you.
Yeah. And real quick before we sign off, I'm going to share my screen again. Hold on. So I can let you know about next week, or not next week, but the next JUMPinar. Here we go. So just a quick announcement for everybody. Our JUMPinars are switching to Wednesday evenings. I mentioned this last week, and it went out in email today, but we're having some schedule changes, and Wednesday evenings at 7 p.m. are going to be the new JUMPinar time. And the next one, the first one that's taking place on Wednesday, will be on April 6th at 7 p.m. And we're covering designs and plans required for rehab projects with Jesse Smith. So you can register for all those upcoming events that are on the screen there at jumpstartgermantown.com, and you'll be able to register, get them on your calendar, and when they come, you're ready. And last is the recording. So you can go to jumpstartgermantown.com/jumpinars and view the recording of our Zoom session tonight. Or if you wait a little bit longer, we'll have the podcast up as an audio-only version, and we'll produce that and send it out when we get the chance. But otherwise, I think that's all we got to cover. Let me check the Q&A to see if anything else came through. Solma was wondering about the Zoom recordings, and yeah, I just answered. We could just go to jumpstartgermantown.com/library, and they'll all be there. But yeah, okay. Thanks so much, Jack. Have a good night, and I'll see everybody in a couple weeks.